CNBC-TV18. Well, let's welcome in our alpha manager of the day is Raj Mehta, fund manager at PPFAS Mutual Fund. Raj, good to have you with us here. Great to speak with you here on the program. Prashant, this side. You know, you look at, of course, all funds at all schemes at PPFAS, but your focus is consumption. If I were to kind of narrow it down a little bit, and in consumption, we're seeing some degree of pain, aren't we? We had last week, for example, I think it was Friday, we had the management of Titan with us. They were talking about some softness. We had Sapphire Foods with us. They were talking about some softness. ABFRL has reported numbers, I think, on Friday. Seems like a demand issue. Devyani's reported numbers, seems to be a problem. Britannia is another case in point. What's the call broadly, Raj? You guys have owned consumption through ITC, but not very much else. Does that still remain the stance? Stay away?
Thank you, Prashant, for having me. Yeah, ITC is the only consumption stock that we have owned in a meaningful position for about 8 to 9 years now. The only other stock or the company we had was Zydus Wellness, which was a much smaller position. Overall view on consumption is that the price that the investors are willing to pay doesn't capture the low volume growth that they are seeing across the board. So if you see the rural consumption growth, that's been pretty low for a while now. And at the same time, when people say that there's a K-shaped recovery, at the same time, we have seen some softness in the premium side of the consumption side as well. So I think that the volume growth will remain low, at least in the near term. And hence, the price that is there in the market for all these consumption stocks is, I think all of them are a little overvalued to our comfort. And we are staying away from the consumption sector overall.
All right. Hi, Raj. Good afternoon. This is Nigel here. Raj, I wanted to ask you about a holding company that's part of your portfolio, Bajaj Holdings. Some of these companies, well, they've seen narrow down of the holding company discount. Could you tell us more about that? Do you believe that that buying some of these holding companies to get exposure to a full group of companies could be a better idea?
Correct. So we have been holding on to Bajaj Holdings for about 3-4 years now. And before that, we used to have exposure to the Bajaj group through Maharashtra Scooters, which is still a smaller position now in the portfolio. So our view is that as long as the underlying companies are doing well, so by underlying companies, I mean Bajaj Finance, Bajaj Finserv and Bajaj Auto, and the holding company discount, as far as it remains constant, the growth in the holding company will be similar to the growth in the underlying companies. And if the holding company discount narrows, then that's an optionality that you get over and above the underlying company's growth. So in some of the companies, especially with Bajaj Holdings, we have seen some discount narrowing happening, but still it's north of 45 to 50%. So it's still huge compared to the global average that you see in the holding companies.
Okay, got that. Raj, hi, good afternoon. I remember up till a couple of quarters ago, you used to own Maruti through the Japanese parent, through Suzuki Motor Corporation. But now, at least in the June fact sheet, I see a direct ownership with Maruti Suzuki. I think 3.5% of your holdings are Maruti. I'm not sure when the change happened. Do tell us when and what the thought process is. Why not the parent? I think you've exited that position and now you own Maruti directly. So what's the thesis?
This change happened about 3 months back. So what happened was, since we are not allowed to invest incrementally in foreign stocks, the Suzuki as a position had become a very, very small position in the portfolio. So what we did was we switched from Suzuki to Maruti Suzuki. And at the same time, we exited Hero MotoCorp also. So the reason for this switch was that in two-wheelers, we are seeing a lot of competition. And at the same time, the electrification theme is playing out much faster in the two-wheelers and three-wheeler side. So it's very difficult to fathom right now as to who the eventual winner will be. And hence, we shifted to the four-wheeler side, where at least the predictability is there, at least for the next couple of years. And the electrification will eventually happen over a period of time. So I think four-wheelers right now is in a good space with the demand sustaining at least for the past 6 months or so. And we have seen the margins coming back in all the auto stocks. So with the commodity prices softening, the margins have also come back.
Raj, India's luxury market is booming and growing at a very fast pace. Just to take the example of watches. Now, Ethos, the seller of premium watches, their revenue growth went up by 33% in the current quarter. And Mangalam was telling us that the average price of a watch sold has doubled in just 3 years. It used to be about 80-90 lakh and now it's become 1.7, 1.8 lakh. In comparison, Titan watches revenue growth in the current quarter was 13.5%. And that you would say largely caters to the middle income in India. So how are you playing this luxury boom in India in your portfolio?
Sure. So there are very limited companies to play this luxury theme. So one of the companies which you spoke about, it's a very, very niche market where the customer base is so small that even on a small base, it's easier to grow. But beyond a point, it becomes very, very difficult. So we have seen that in the premium two-wheeler space as well about 5 years back, where it was easier to grow up to a certain size. And then after that, it becomes difficult to grow. So the same way in this luxury market as well, as long as they are able to capture the market quickly, they will be able to gain market share in the luxury space. But beyond a point, they will also find difficulty in terms of growing their customer base. So, and apart from that, there are many very limited players per se to play on the luxury side.
Sorry, you said there also there is some slowdown. Can you give us any data points which kind of point to it?
Yeah, so data points was mainly say Titan in terms of jewelry. As also we have seen some slowdown happening across the board. So not only Titan but other jewelers also we have seen some slowdown. So by slowdown I mean the growth hasn't been up to the expectations that the investors had, and that's why I see that overall the consumption has been with the inflationary trend, the consumption has been under pressure.
Okay. Raj, what about the foreign part of your portfolio? I mean, I still see all the stocks here. Microsoft is still over 5% of your holdings, Alphabet, Amazon, Meta. Any changes here last couple of months? And what's the thought now when you're looking at big tech in the US? Yeah, are you happy with your holdings?
Very happy with the holdings. No changes here. All the companies have been doing well in terms of the quarterly results that they just declared. All of them did well in all the subsegments that they are present in. Cloud computing, digital advertising, e-commerce, every segment continues to grow. And all of these mega tech companies continue to grow their market share. So no complaints there. Only complaint is that we cannot invest incrementally over there. The only amount we can deploy is the dividends that we receive from these companies. So yeah, that's.
So while you own big tech, US big tech, you also own a small position in Infosys. I think it's just about 1.5%, not too big. So leave us with a thought there, because I mean that's where the biggest question marks are on large Indian IT services companies. What do you think?
Sure. So we also have a position in HCL Tech, which is about a 5% position. The view there is that your expectations need to be muted. So what we have seen is that last couple of years, these IT companies have had a phenomenal growth, and the expectations of the investors also went up simultaneously with that. So if the expectations are muted, and if you look at the longer term growth of most of these companies, it's been in the range of mid to a high single digit kind of constant currency growth. So if you have those kind of expectations, I think these companies over longer term could do well. In the shorter term, you could face some pressure, but the shift to digital is here to stay. And most of the companies will spend on the digital side going forward as well.
Raj, thank you very much for joining in. Need to slip into a very short break. As always, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls from our experts.